If you have lost money due to a market crash, this video is for you. The mistake most people make is that they think that wealth is built by reacting to every market move, instead of sticking to a long-term plan. Think about this. You are scrolling through your phone at midnight on social media, and all you see are screenshots of people making money trading crypto or stocks. You just saw someone made $50,000 in a week and another made $30,000 through day trading, and you were like, why can't I be like these people? You think you are missing a golden opportunity to build wealth. But here is the truth they won't tell you. For every single person who won a trade, there are thousands who lost, and you might probably not hear their story because they are ashamed of posting their loss on social media. That's why in today's video, we're going to look at the boring strategies smart investors use to build and grow their wealth steadily without watching the market daily or stressing about market crashes. The number one strategy smart investors use to grow their wealth is simple. They don't try to beat the market. Yes, you heard that right. Smart investors don't jump in and out of trades or try to time market tops and bottoms because one bad decision can wipe out months or even years of savings. For example, take the gold and silver January dip. When prices were crashing, many people panicked. Some sold at a loss. Others tried to trade the bounce, hoping to recover quickly, and ended up losing even more. But smart investors did the opposite. They didn't panic. They didn't overtrade. They stayed invested because they understood that markets move in cycles. Think of you running to catch up to a moving train at high speed. You will get exhausted along the way. That's how the market works. Smart investors know that trying to beat the market is like trying to run faster than a moving train. You'll get exhausted and eventually fall behind. So instead of chasing the train, smart investors do the opposite. They get onto the train and sit down while letting time, consistency, and the market itself do the heavy lifting. That's how real wealth is built. Quietly, steadily, and without daily stress. The number two strategy smart investors use to grow their wealth is consistency. What I mean by consistency is that smart investors don't wait for the perfect time to invest. They invest regularly, whether the market is up, down, or boring. That's where dollar cost averaging comes to play. By investing regularly, they are not under any pressure to time the market. Instead, they invest more when prices are low and less when prices are high. For example, think of it like planting crops in your backyard. You don't plant only when the weather is perfect. You plant consistently and let time do the growing. The third strategy is that they don't invest money they cannot afford to lose. Now, this is where most people get it wrong. If you invest your rent money or emergency fund when the market witnesses a pullback, it feels like a disaster to you. You find yourself thinking about your money. Smart investors do the opposite. They separate investing money from living expenses. That's why during market crashes, they don't panic or sell at the worst time. Instead, they give their investment time to grow. Remember this, if losing the money would keep you awake at night, it doesn't belong in the market. Your peace of mind should always come first because your health is more important than any return. The fourth strategy is that smart investors don't invest heavily in risky assets like crypto. Instead, they put most of their money into proven, long-term assets like index funds and ETFs. What I mean is that smart investors prioritize stability over quick returns. If you are new to the market or already following the market, you will notice that risky assets like crypto are prone to high volatility. For example, since the early October 2025 market crash, Bitcoin, the largest cryptocurrency, has dropped by over 40%, wiping out thousands of investors' portfolios. While many people have kept hoping for a rebound, every dip has been followed by another dip, leaving people stuck in pain and uncertainty. Meanwhile, the S&P 500, which tracks the top 500 companies in the US, did the opposite. It rebounded a few weeks later, recovered its losses, and went on to hit a new all-time high in December. This is where index funds and ETFs come in. Instead of trying to pick individual stocks, smart investors invest in ETFs. In essence, they are not betting on one company to succeed. Instead, they invest in ETFs, which give them small fractions of many companies at once. That diversification spreads the risk and protects them from the collapse of any single stock. Even though ETFs may look boring and don't offer quick returns like cryptos, they're a powerful route to building long-term wealth. For example, funds like VOOETF, which track the S&P 500, have averaged over 10% in annual returns over the past 5 years. Now think about someone investing $500 monthly at an average annual return of 10%. Within 10 to 15 years, they could be well on their way to early retirement. Although when it comes to quick returns, risky assets like crypto can experience sharp upswings, helping people build short-term gains. Smart investors don't build their entire portfolio on them. If they invest in crypto at all, it's only a small portion, not the foundation. They rely on stable assets like ETFs and index funds to grow their portfolio consistently, sleep peacefully at night, and let compounding do the heavy lifting over time. The last strategy smart investors use to build wealth is investing in real estate. Although seen as old school, real estate has proven over and over again as one of the most reliable ways to build long-term wealth. The reason is that housing sits at the center of three powerful forces, which are inflation, population growth, and basic human needs. With the rising inflation, you will notice that the cost of building materials, land, and labor has continued to skyrocket in the past years, which has pushed housing prices higher, with property value also appreciating in the process. You will observe that while this happens, the cost of renting also goes up because people will always need a place to live. For example, think about houses bought during the 2008 financial crisis, or those bought 5 to 10 years ago. Many of them have doubled or even tripled in value, while the rent they generate has continued to rise year after year. This is why real estate works so well as a hedge against inflation. While money loses purchasing power, property values and rental income often rise with it, allowing investors to protect their wealth and grow it steadily over time. One of the unique things about investing in real estate is that it gives you three things: steady cash flow from rent, long-term house price appreciation, and higher resale value. And unlike speculative assets, real estate is tangible. You can see it, you can rent it, you can improve it, and even during downturns, property value rarely goes to zero. That's why smart investors use real estate as a foundation asset. Something solid that grows quietly over time, protects against inflation, and helps build generational wealth. And this is the mindset that matters in 2026. Building wealth today isn't about chasing the next big thing. It's about choosing assets that appreciate, not depreciate. While a lot of people spend money on things like cars that lose value every year, smart investors focus on assets that grow with time. Remember, you don't need to start big, you just need to start steady. Small, consistent investments, made month after month, can compound into real freedom. So, if your plan is to retire early or secure your future, waiting only makes it harder. The best time to start investing was years ago. The second best time is now, because time waits for no one. The longer you wait before investing, the more ground you lose. Now, before we wrap up, let me ask you these questions. Have you taken any steps toward investing, or are you still telling yourself you'll start soon? If you've started, what are you investing in right now? And how far have you gone in your investing journey? If you have not started, what's really holding you back from starting to invest? Is it uncertainty about where to begin, or are you waiting until things feel more stable? Remember this: the decisions you make today will shape your future. The question now is, what choices are you making right now to build the life you want tomorrow? Remember, this video is not financial advice. It is only for educational purposes. Always do your own research before investing, and do not invest what you cannot afford to lose. If you found this video helpful, like, share, and subscribe. Thank you.